few management teams act in shareholders' best interest in this way. And that is just what I really love about Copart. They also have a really strong balance sheet, and this allows them to take advantage of opportunities that happen to pop up. For example, IAA has recently been losing business from Geico, who has been transitioning to Copart because when a natural disaster hits, Copart has shown that they take care of their insurance partners when they need them most, while their competitors have largely neglected that. Hey everyone, welcome to the Investors Podcast YouTube channel. I'm your host today, Clay Fink. Recently, I did some stock analysis on a really incredible company called Copart, and I figured I'd put a video together chatting about how I think about the company, what sets them apart and makes them a long-term compounder, and how I view the intrinsic value of Copart today. So in this video, I'll be covering the business overview, Copart's competitive advantages, and then performing an intrinsic value analysis and sharing how I think about the valuation. With that, let's dive right in. So before we dive into what Copart does in their business, I wanted to play this clip from Chris Mayer, who I recently interviewed on the We Study Billionaires podcast. We'll just go ahead and play the clip here for you. Maybe you could share one of your higher conviction holdings.
Well, I only have like 10 names, so they're all pretty much high conviction names at this point. Yeah, I mean, we mentioned a couple, I certainly think Copart's a really good one, particularly because now their chief competitor is kind of put up the white flag. IAA agreed to be acquired by Ritchie Brothers, and I don't know whether that deal will happen or not. The Ritchie Brothers shareholders are rebelling, but you clearly have a wounded, distracted competitor that is at, I think, a structural disadvantage at this point that would take a lot of time and a lot of money, and it wouldn't even be certain that they could equalize Copart. So that's a good one. And Copart still, seems to get better with age as the network effects kind of take hold, and they still have plenty of room to expand overseas. So that would be one. Super clean balance sheet. And great team. Really good capital allocators. This is a team, they're not paying any dividend. They're reinvesting everything. So very good compounder still.
That is another great point that you brought up related to Copart. You mentioned some research that was done for Copart related to their competitor, where the competitor was paying out dividends and Copart was keeping the money internally and reinvesting. And the difference in their returns, just like, is astounding over time. So it goes to show, the importance of great capital allocation. And, if you have a great capital allocator at the helm, they're going to recognize that if you have a great business and you have reinvestment opportunities, then dividends aren't a great use of capital because that's money that could be used to deploy, internally within the business. So I think that was also a really great point that I think a lot of younger investors overlook. Some people get attracted to dividends.
Yeah, that was one of the more controversial things that Thomas Phelps said in his book when he wrote that dividends are an expensive luxury. And it's just basic math. If you have a great business, you'd rather they take all the cash and keep reinvesting it if they can. There's certainly a place for dividends. You don't want companies to just take the money and invest in lower quality businesses or blow it on stupid acquisitions and things. So there's definitely a place where eventually companies should pay a dividend. But if you're focused on looking for these big multi-baggers, then probably not going to be in a dividend payer. Now, sometimes, company returns might be high enough where they could still pay half of their cash flow out of dividends and still compound really high. And there's rarely, but you'll find every once in a long, long while, you'll find a business that can grow without any reinvestment at all and has very high returns. And so it's a math problem. It's some combination of returns and reinvestment that you want to get a good compounding number.
So there you have it from Chris Mayer. One of his very favorite holdings in his fund is Copart for a number of reasons that we'll be chatting about today. If you'd like to check out my full conversation with Chris Mayer, you can go to episode 543 on the We Study Billionaires podcast feed. It is definitely one of my very favorite interviews, as I am just a huge fan of his book, which is called 100 Baggers. So what exactly does Copart do? Copart provides online auction services to sell and remarket used, wholesale, and salvage title vehicles, and they operate in a number of different countries, including the US, Canada, UK, Brazil, Ireland, Germany, Finland, among many other countries. On their site, they also offer a number of different services, including salvage estimation, end of life vehicle processing, vehicle inspections, dealer services, as well as a membership service that gives you access to their network of vehicles and buyers and sellers. This isn't a business that catches a lot of people's attention, as most people probably don't want to own a junkyard that sells cars, but this should actually excite investors, in my opinion. Even investors like Peter Lynch, for example, say they want to invest in companies that aren't in sexy industries because those are the types of companies that have the potential to be overlooked or maybe even ignored by many investors. Copart started all the way back in 1982 with a single salvage yard, and they've grown to become a global leader in the online auction space for vehicles. The company IPO'd back in 1994, and it's really been a strong performer as the stock has risen from a split adjusted price of just 30 cents per share to around $77 per share today. Now, Copart has two main revenue streams. They have their service revenue and they have their purchased vehicle revenue. Service revenue is essentially when someone lists a car on their site and they collect a fee on the sale for being the intermediary. In this case, they're not actually taking ownership of the vehicle. In 2022, service revenue was $2.8 billion, and that was up 24% year over year, and that accounts for 80% of their business. The other 20% of their business is their purchased vehicle segment, and that refers to vehicle sales where Copart takes ownership of the vehicle and then it goes and sells it at a higher price and pockets the difference. In 2022, purchased vehicle revenue came in at $648 million, and that was up an astonishing 61% year over year. So, what is it that makes Copart so special and gives them a competitive advantage over their competition? Now, in researching Copart, I came across this presentation by Luxor Capital that was recommending that a company called Ritchie Brothers not acquire Copart's primary competitor, which is a company called Insurance Auto Auctions, otherwise known as IAA. That's the company here shown on the right side of the screen with Copart here on the left column. Now, Copart operates in an industry that is essentially controlled by two players, Copart and IAA. These two players control 80% of the market, 40% of which is controlled by Copart. The competitive landscape is not really a situation where there are dozens of players and you don't really know who the clear winner is going to be. I heard Chris Mayer, who I had on the show, once say that he was speaking with someone who worked at IAA, and he asked him how difficult it was to compete with Copart. And the guy evidently told him that you'd be crazy to compete with this company. You'd have to get all these physical yards all over the country in places where it's really tough to get the land. And then from a physical perspective, it's just not the type of business that people seem to get attracted to. It's not like venture capital money is attracted to this industry and money's flowing into it. So here you can see on the slide the comparison between these two companies in the presentation. And at the top here, you can see it says Copart versus IAA is not a fair fight. And I just wanted to walk through this slide. Copart has more buyers, more sellers, a stronger network effect, a stronger balance sheet, far more EBITDA to invest out of, an advantage cost structure from owning their land, and an experienced management team. And all of this combined just makes it so difficult for IAA to compete with them. So here you can see the market cap. Copart is much bigger, 33 billion versus 5.9 billion. EBITDA, almost 1.5 billion, nearly 3 times as much EBITDA, so much more profitable, almost over double the employee count. So Copart owns 17,000 acres while IAA, leases their land. That means that Copart has operating leverage as their revenues increase. Their costs tend to stay flat, which means if their revenue increases by 10%, then their profits are most likely going to increase by an amount higher than that. That's operating leverage. In the balance sheet, 1.5 billion in net cash. IAA has 3.5 billion in net debt. Then capital expenditures, Copart's investing much more in the business. And then co-CEO, founder-led. Copart's management team is just exceptional, which I'll be getting to later. Then IAA has a new team in the industry. Now, zooming ahead to the next slide here, IAA market share over time. This slide shows that essentially since 2016, Copart has steadily taken market share from IAA year after year after year. Here you can see on the slide, Copart, the number one player, has been eating IAA's lunch for over half a decade. IAA has been bleeding market share to a much larger Copart for many years. And it shows the relative market share between the two. Here's Q4 2016. And then year after year, you can see Copart's share goes up while IAA's share goes down, which makes sense given what we saw on the previous slide. Now, jumping ahead to slide 37. And this slide just really drives it home for me. Here, I'll just read through it. IAA has severely lacked reinvestment. While Copart invested billions into its business to gain an edge, IAA had its business bled dry by its prior parent, KAR, who used it as an ATM machine. So the owners of IAA were essentially just sucking out dividends and sucking out payments with just totally neglecting, the business in its growth and its strengths. Now, Copart has invested 4 times the amount of CapEx into its business versus IAA since 2016 when it decided to reinvest heavily in its business. Now, here you can see CapEx for Copart is almost 2.5 billion, and then IAA is around 600 million, so it's a huge difference between the two. This is in spite of Copart paying down $700 million of debt, while IAA issued nearly $1.3 billion of debt in the same period. So just a totally different approach here. Copart paid down almost $700 million in debt here. And then you can see IAA just issued a bunch of debt, became a weaker business, has a weaker balance sheet. Now it says Copart invested dramatically more than IAA while also adding nearly $1.4 billion of dry powder, while IAA added more. So that's here at the bottom, the cash flow after all of these things considered. Copart produced nearly $1.4 billion in cash, while IAA really isn't producing any cash after all these cash flows are considered. IAA's ability to reinvest was hampered for years by its then parent, KAR, who bled IAA's business dry by extracting dividends. So I believe that Copart has really strong competitive advantages that has positioned them to be able to grow for the many, many years to come. First, they actually own the land that they use in their operations, while their competitor leases their land, which creates economies of scale for Copart. This means that as the cost of the lease of the land for their competitors increases over time, Copart has a bigger and bigger advantage because their cost of owning the land is relatively fixed, and owning the land gives them operating leverage. So as their revenues increase, their profits are increasing at a faster rate because a portion of their costs are fixed. Plus, getting the land to compete with Copart can be really, really difficult. Most people don't want a junkyard in their backyard, and Copart acquired a lot of this land back in the 90s, and you have all these different zoning laws and different regulations. And really, it just comes down to Copart's management team playing the long game, while their competitors are optimizing for the short term with their dividend payouts and other poor things that they're doing. The second advantage I want to mention here is their network effects. Copart has an online platform to buy and sell cars, and the larger that platform gets, the better it is for users. Buyers want to go to the platform with the most selection and the best prices, and sellers want to go to the market with the most buyers so they can get a good price. This creates a self-reinforcing cycle with huge tailwinds for Copart. And then the third competitive advantage for Copart is their barriers to entry. When you have a business that is making a killing in an industry and it has high profit margins, that catches people's attention and they want to come eat your lunch. So you need to have a barrier to entry in order to prevent competitors from stealing your profits and preventing you from continuing to increase your revenues and your profits. And again, the land ties into the barriers to entry here too, because it's so difficult to get all that land that Copart has and then go and create all these junkyards. Plus, you have things like the relationship that Copart has built with all these insurance companies and other partners. The last advantage that I wanted to highlight here is their management team. One of the first things I like to look at when analyzing a company is their management team and their insider ownership. Willis Johnson founded Copart, and since then he has stepped away from the operations, but today he still owns just shy of 25 million shares, which is valued at 1.9 billion. The co-CEO of Copart owns 5 million shares, and that's worth around $400 million. This is just what I love to see in a management team. Managers, instead of getting huge stock-based compensation, they have substantial ownership of the company, and that aligns the interests of the managers with the interests of the shareholders. Next, I like to also look at the return on invested capital when analyzing management. When I pull up our TIP finance tool, I see that the return on invested capital has been in the mid teens through 2016, and ever since has averaged around 25%, which is just exceptional. Copart's managers, really, in my mind, are best in class. They think long term and they allocate capital really effectively. And their return on invested capital has even increased in recent years, and that return on capital has been really, really consistent. As the company's stock performance has shown over the years, management is just really exceptional capital allocators, and that is what has led to this superior performance of the business. They're also looking for the best use of capital at all times. If their stock is trading down, then they're open to doing share repurchases and acting opportunistically. If they see places where they can expand and achieve a really high return, they're open to doing that too. And maybe even at times, they'll look to pay down some debt. Very few management teams act in shareholders' best interest in this way, and that is just what I really love about Copart. They also have a really strong balance sheet, and this allows them to take advantage of opportunities that happen to pop up. For example, IAA has recently been losing business from Geico, who has been transitioning to Copart because when a natural disaster hits, Copart has shown that they take care of their insurance partners when they need them most, while their competitors have largely neglected that. Having the balance sheet to help weather through those difficult times is extraordinarily helpful for Copart. And then the other reason that they have a strong balance sheet and hold so much cash is because they want to be in a position to opportunistically buy back their own shares. Turning to the valuation here, Copart is definitely not a cheap company when you look at the multiples. I put together this spreadsheet here that's going to help me wrap my head around the valuation, and this will be available in the description below for those interested in checking it out. As you can see here, the market cap of Copart is around $37.6 billion at the time of recording. The reported free cash flow is 843 million. This gives it a price to free cash flow of 45, which is pretty high. But then I wanted to look at a more normalized multiple if we excluded the company's growth capex. And then I got to a price to free cash flow of 35. And then I have some statistics here looking at the revenue growth, free cash flow growth, and return on invested capital. The 5-year average revenue growth rate has been 14.1%, and then the free cash flow growth has been 27%. So as you can see, they have enormous operating leverage that I was talking about earlier. Their free cash flows and their earnings are growing much faster than their revenues. And then here, the 5-year average return on invested capital is 24%, which is absolutely exceptional for a company that is heavily reinvesting back into the business. So really good to see as potential shareholders of Copart. And then here I have an intrinsic value projection where we're going to be calculating an intrinsic value amount here. And then that's going to be compared to the company's current price or the current market cap. So here you can see this first line, the first 5 years, I'm projecting out the company's free cash flow growth. Here I have 18% is what I have assumed in my base case. And then from years 6 through 10, I assumed a 15% growth rate. And then I put a terminal multiple on it in year 10 and assume that we sell the company in 10 years rather than projecting out further than that because it's just so hard to predict what's going to happen that far in the future. So I used a conservative multiple of 25, which is much lower than the current multiple of 45 today. And then I used just a flat discount rate of 10%. I try not to complicate my discount rate too much. And then here we're starting with the 843 million in free cash flow, and that's growing by 18% for 5 years, and then 15% for the next 5 years. Then we have the terminal multiple of 25, and then we're discounting that back to today at a 10% discount rate. And using these growth rate assumptions, I came up with an intrinsic value of 49 billion. Now, it's going to take a lot for Copart to achieve this level of growth, but I think a lot of the pieces are in place for them to grow at a pretty good rate. But definitely there's no guarantees, and you shouldn't take these growth rates at face value. You could plug in really any numbers and make any company look cheap, but this is probably a more optimistic case where they grow at 18% and then 15%. But I really trust in management's ability to continue to grow earnings at a reasonable rate for the next 10, 20 years. So here you can see with a 18% and 15% growth rate, there's a 24% implied discount to the intrinsic value. And then I want to look at a more bearish case to try and, be a little bit more reasonable, or what might happen if the company's growth were to slow down. So here I did 14% growth for the first 5 years and then 11% growth for the next 5 years. And then my multiple, instead of being 25, is only 20. And then here you can see the intrinsic value calculated is around 31 billion, and that is below what the company's current price is. So if you believed that the company was going to grow at around this rate, then you wouldn't want to purchase it at today's price. All right, so there you have my thoughts on the intrinsic value of Copart. Most likely, the company is probably reasonably priced today, and if I had to guess, might provide a 10 to 14% return over the next 5 to 10 years, of course, if all goes well. And of course, none of this should be considered a recommendation to buy or sell shares in the company. It seems to me that the more I read about Copart, the more I really like their business. They have a really strong track record, fantastic management, and a long runway ahead for them. If you enjoy learning about individual stocks and what companies I'm currently analyzing, then I'd encourage you to check out our newly launched TIP Mastermind community. We have a lot of members in the Mastermind community who are passionate about investing in individual stocks and sharing ideas with others. In the community, you get access to a forum to network with others, live networking opportunities, and Q&A sessions with the Investors Podcast hosts, including myself, and special guests, a library of exclusive content that is growing each week, as well as access to our TIP finance tool. Spots are limited within the community, so be sure to check it out today. And we even offer a 30-day satisfaction guarantee, or you get your money back, no questions asked. You can check out the community at theinvestorspodcast.com/mastermind, or simply click the link in the description below. That is theinvestorspodcast.com/mastermind to check out the community today. All right, that wraps up today's video. If you enjoyed this video, you may also enjoy my recent podcast episode covering Topicus.com and Copart. I did some stock analysis on both of these companies and went into more detail on Copart specifically. That is episode 549 on the We Study Billionaires podcast feed for those interested in checking that out. Thank you so much for tuning in. If you enjoyed this video, please do me a quick favor and click the like button below so others can find the channel, and let me know what you think about Copart in the comments section. I would absolutely love to hear from you. Thanks so much again for tuning in to today's video.
That a pilot's job is hours and hours of boredom punctuated by moments of sheer terror, which is where I got that quote. It's the same in investing. What really matters is just how you respond 1% of the time. 99% of investing is really boring. But what you do 1% of the time will change your life.